Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And welcome into the program, ladies and gentlemen. This is Navigating Retirement. Charleston, Low Country, your resource for a common sense approach to planning, is always the voice of the Coastal Financial Planning Group. Rick Durkee here with us once again. Rick, welcome back. Good to see you.
Great to see you too, Peter, and great to have our listeners back here on Navigating Retirement with another great subject I've got today for us.
Absolutely. Well, Rick, we've been talking about this little bit of a theme here over the past couple episodes, and that is defined outcome investing, understanding what your results are going to be when you save or invest your money. It seems like that would be something that's important and attractive to a lot of people. I mean, with this grand experiment with the 401k, we've worked hard, we've saved our money, we've invested it, but there was no defined outcome there like what we used to have with pensions. But you are again saying here today that having a defined outcome is not only possible, but probably something that most people should consider, at least with part of their money, because we know that there's different types of markets, and we want to understand what our results are going to be, regardless of what kind of market condition we're in.
Yeah, we've certainly experienced different types of markets here lately, haven't we? And looking at those different types of markets, we need to be positioned properly so that we're ready when it's time to retire, that we've got the funds we need to create the income we need. So we need that defined outcome, and we need to define that up front. We need to have an income plan. We need to have that in writing. And we need to be able to make sure that we're going to be safe through times like we're in right now, so that we have a defined income as to our accumulation of those assets when we're still trying to grow those assets, when we're in the growth phase.
Well, Rick, when we do invest money, it's always projections. It's hypothetical. We should have this much. We'll probably have this much. We think or hope we'll have this much. But that definition, defining what that outcome is going to be, has been something we've been told is not really a possibility with investments.
No, in fact, in the past, models that were called Monte Carlo models would give us a probability for success based on thousands of different market scenarios. And I don't want a probability for success in retirement. I want a defined outcome. I want my investments to be set up so that I know what I'll have for income. It's very important that we structure our plan to be able to do that. And it's very difficult to do that when we don't know how the markets are going to react going forward. In fact, they even require a disclaimer when you look at Wall Street investing that says past performance doesn't predict future results. So if we can't predict future results or have a defined outcome, we're just back at square one here. We don't have a defined outcome with a pension. We have a 401k. And we have risk. We have risk that the money's going to run out. We have risk that the money's not going to last long enough. We have risk that the market's not going to do what we need it to do to cooperate with us, to give us the returns that we need to make sure we don't outlive the money.
So, Rick, in this uncertain world, we can't control the market. We can only control how much we choose to expose to the market. But it seems like the other option, if we're not in the market, has been very low interest rates. How can we have some predictability of outcome with reasonable growth without the uncertainty of an uncontrollable market?
Well, there are different ways you can do it with insurance-based products as alternatives. We can do it with some safer investing, some safer investing methods. When I say the word investing, though, Pete, that means there's risk. There has to be risk. But it could be defined risk. It could be, I will withstand a 5% loss in my accounts if you can promise me a 7% gain. That would be favorable, because most people understand that a 5% loss in investments is pretty much commonplace. It's noise.
It does happen from time to time, pretty frequently.
It happens actually, historically, it happens about every 3.5 months on average that a 5% drop happens. It's the 20, 30, 40, and 50%. It's the 35% that happen in 20 days that we recently experienced that can really kick a retirement plan, where. So we have to evaluate these different types of stock markets, and we have to structure through structured notes an opportunity to look at, as far as investing goes, that gives us a higher probability for success. And so I think maybe if, Peter, we could talk a little bit about the different types of markets here so people understood those, and then we can move forward from that.
Sure, absolutely. Rick, we know that the market does move. We don't know which direction it's going to move, but there's basically three.
Mm-hmm. Yep, there's three types of markets. There's normal markets, and this is the market we experience most often. We're happiest in this market, right? Things are just kind of slowly but steadily going up, and we're participating in those gains, and we're happy. We're not seeing any of the drawdowns or the big downturns. It's a benign market. Sometimes it's even a flat market, and we're happy with that. It just flatted out. It just had a 1% gain this year, but the year before that, it had a 15% gain, and next year it has a 7% gain. So we're okay with a benign market. Market tends to drift upwards over time and only has modest volatility. So that's your benign or normal market, okay? Second type of market, we see market corrections. Market corrections, as I mentioned earlier, can happen pretty regularly when you're talking about a 5% drawdown about every 3.5 months on average during normal market cycles. The S&P 500, as used as a benchmark index, will drop about 5%, like I said, about every 3.5 months. In that 10% drop, however, that's going to happen a little bit less frequently. About on average, about every 18 months historically. But it's the 20%er that we really got to look out for. And we have to look out for those corrections that sell off really quick. The market sells off really quick, and then it looks like it's going to be a V. It's going to bounce back, and we're going to be back in. Everybody's going to be hunky-dory. It looks like that 20% just went away really fast, like it did at the end of 2018. In the beginning of 2019, it bounced back really quick. A 20% drop. It was 19.9 at that time period that we had a drop in December, and then back, we're back by February. We're back to break even and climbing high again. But it's these, quick drops that we got to be careful about. We got to, show in these market corrections that we're going to definitely have some volatility, some negative volatility. And remember, volatility is good and bad. It can go up and down. Markets can go up and down. The market correction time periods are the second type of stock market. And the third type is a market recovery. Now, this is where you can really get blindsided, because you might think that things are going up and you're going to be okay. We're going to see the recovery. And then all of a sudden we see a W. The market bounces back down again. And this is where the weak hands are shaken out. If you use a poker analogy, people are like, oh man, I'm really close to retirement. I got to get out this time. I'll take my losses. Personally, my example, I did that with my investments. I'm sitting in more safe investments right now because I lost about 5% versus the 35% that was lost in the S&P 500 back in the correction we just had recently here with the COVID virus. So three types of stock markets. I would say this: be careful if an investment advisor says that they can weather any of those three types of markets at any time, and I've got the perfect I've got the perfect investment that'll take you through any of those three markets. Any manager that says that he can win in all three of those markets, not only run, but run fast. All right. You're going to run into some kind of an issue. History is going to prove that. Be skeptical of that. The best money managers in the world typically can outperform in two, maybe of those three markets. And the average money manager can outperform only in one of those three markets. So you want to have some type of structure to your investment program that's going to give you a defined outcome that can give you a high probability of success for working in two of those three markets. And I'll just put it out to our listeners right now, Peter. which two markets, if you could choose to, would you want to outperform in? Okay. If you want to find out more about that, I would ask for our white paper that we have today on structured note investing. You can look at structured notes in that white paper that I've created for you and spend some time on it. And then you can easily book a 15-minute, no obligation, no cost, no stress appointment with the Coastal Financial Planning Group. And we can do that virtually. So there's no pressure on you to make any decisions, just to get to know one another and find out if defined outcome investing is right for you.
Well, there is no benefit to procrastination. There's no downside for placing the call. There is no need to meet in person to get started on the path toward a better financial future. The team from Coastal Financial Planning Group and Rick Durkee, the founder and CEO, can speak with you over the phone. They can answer specific direct questions over the phone. They can conduct a complimentary, comprehensive review virtually through the ease and convenience of technology for your safety, for your convenience. And they can also extend the offer now as we are reopening for that in-person review and evaluation. All you need to do, pick up the phone, give a call to get started, 800-491-6220. That's 800-491-6220, 800-491-6220. You can also visit the website, cfpgroup.biz. Lots of great resources there. The white paper, reports, calculators, tools for you to be more educated and informed, because informed people make better decisions. If you'd like to understand how to have a defined outcome with your investing, with your savings, with your financial progress, pick up the phone and give a call, 800-491-6220, 800-491-6220. Rick, we always appreciate your time. Thank you for bringing this important information to the listeners here on Navigating Retirement.
Thank you, Peter, and thank you to our listeners, our clients, and everyone throughout the U.S. and Canada. Thanks for listening to Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.